One of the most common objections that I hear about annuities is they have high fees. But do you know that not all annuities even have fees? And the ones that do are typically the ones protecting your income for life. In this retirement income school lesson, I'm breaking down the four main types of annuities: SPIAs and DIAs, MYGAs, FIAs, plus one category I don't recommend as a safe money strategy: variable annuities. By the end, you'll know exactly which annuities charge fees and which don't, and what you're actually paying for. That way, you can make confident, transparent decisions about your retirement income. I'm Dr. Amanda. Welcome to the Retirement Income School. This is your place for financial education to learn how to protect your wealth and generate guaranteed income so you can retire financially relaxed. Let's jump right into the truth about annuity fees. There are four types of annuities. We've got MYGAs, multi-year guaranteed annuities, income annuities, which are categorized as SPIAs and DIAs. That's a single premium immediate annuity and a deferred income annuity. And then there are FIAs, which are fixed indexed annuities. And then there's one more category that is a variable annuity. And I don't recommend these because they are not a guaranteed safe money solution. Because in this lesson, I'm focusing on fees, I want you to notice that a MYGA has no fees. A SPIA and a DIA, no fees. A fixed index annuity or an FIA, no fees, unless you add optional riders or features. So 3 out of the 4 annuities have the opportunity for you to have a no fee annuity. Yet it's really common for me to hear people talk about high fees. It's one of the number one objections I hear. And when I educate clients on the fee structure, a light bulb goes off because they realize that what they've heard about annuities may not be true, and they might just be hearing about variable annuities. And in this lesson, I'm going to break each one of these down so you really understand the ins and outs of the different types of annuities, why you would want one over the other, and how the fee structures work. First, as an overview snapshot, a MYGA has no fees. It's a way for you to earn a guaranteed interest rate for a period of 3 to 10 years, and there's no market exposure, and it's a very simple structure. For an income annuity, if you're choosing a SPIA or a DIA, again, no fees, you can exchange a lump sum for lifetime payments, and the costs for the SPIA or DIA are included in the payout rate. So there's no fees, and you know right up front the monthly amount that you're going to receive. It can be a single income or a joint income. With an FIA, a fixed index annuity, again, there are no fees unless you add additional riders. Something like a guaranteed lifetime income rider will have a fee, but when you add that fee, you're paying for guaranteed lifetime income. So you can very clearly understand why that annuity would have a fee. An FIA is also something that a lot of retirees like to use because it offers principal protection, and because an FIA is linked to an index, you have the potential for growth. And the way that an insurance company makes money from an FIA is through a spread. What that means is that they're taking the principal that you put into the FIA and they're investing it in safe investments and giving you a certain amount, and they are taking the spread, the growth. Think about a CD. When you go to the bank, do you think that when they're paying you 3%, that they're only making 3%? No, it's a spread product. So they're taking your money and they're investing it. Bank is different because they're investing it and they're making 9, 10, even up to 20, 25% when they're giving loans, but they're only giving you 3 to 5%. In an annuity with an FIA, you're typically going to see about 4 to 8% of index crediting on your FIA. So they're not taking as big of a spread in an insurance company as a bank would with something like a CD, but it is a spread product. Now with variable annuities, I don't sell them because they have the highest fees and they're subject to market risk. When you're wanting guaranteed lifetime income or protected growth in your portfolio in the era of retirement, I don't prefer variable annuities because they're not a contractual guarantee. You're subject to market risk, there are high fees, and the fees continue to be charged whether or not you are winning or losing in a variable annuity. And so this is not a type I recommend, but it is one of the main 4 types. And it is the one that most commonly is the reason that people say annuities have high fees. I did a breakdown with a client recently where we reviewed their policy, and they had had the policy for a long time, over a decade, and thought that they were getting a good return. But when we broke down the fees, they were actually only averaging under 4% per year because of the high fees, and they didn't know that. So it's really important that you look at the illustrations and work with somebody who understands what's going on and can explain it to you in plain English so that you know what you're getting charged and why you're getting charged those fees. So let's dig a little bit deeper into the different types. With FIAs, fixed index annuities, you can get them with or without an income rider. Now, without a rider, 0 fees. And the growth is tied to a chosen crediting method, meaning that you're going to be tracking various indices and your growth is tied to those indices. You're not investing in the market, but you have the opportunity for growth and you have downside protection, meaning you're never going to lose in a fixed index annuity. And you have full liquidity within contract limits. What that means is that it's very common for an FIA to allow you to take out up to 10% per year without any penalties. Now, an FIA with a lifetime income rider is going to have a fee, and it's very transparent in the illustration and in the contract. What you're typically going to see is about a 0.9 to 1.25% fee on the benefit base. What this does is that it gives you the opportunity to have guaranteed lifetime income. So for retirees, this is one of the biggest benefits to paying that fee, is that no matter how long you live, you're going to get the same amount every month for the rest of your life once those payments start, unless you decide to take out a 10% withdrawal from your annuity, then your income might change. But in most cases, when people are purchasing fixed index annuities with an income rider, they're deciding when to turn that income on. And once they turn it on, they're getting a paycheck for the rest of their lives. And it's ongoing. It never ends, no matter how long you live. Now, this is a huge advantage to make sure that you fill that income gap that I've talked about and to make sure that you have a secure, guaranteed lifetime income. That's why I like FIAs with income riders for retirement income versus, let's say, a variable annuity where you have fluctuating risk and you don't have a contractual guarantee. An FIA with an income rider is also going to give you well-being benefits, and some companies have income doublers or enhanced benefits where they will give you a multiple of your monthly payment if you have a long-term care event or a chronic care need. Now, again, you want to pay attention to the contractual guarantees and ask questions. When you're working with an insurance agent, make sure you ask them, are there well-being benefits attached to this annuity? What are the enhanced income benefits? Ask these questions so that you understand what the fees are going to give you. And remember, fees aren't necessarily a bad thing. What you're purchasing when you pay this 0.9 to 1.25% fee on a fixed index annuity with a lifetime income rider is that you're buying a guaranteed paycheck. That's not a mystery fee. It's very transparent in the illustration. You can see exactly how it's deducted. You can see how the interest is credited, how potentially bonuses are credited if you have an FIA. And I'm not going to go too into the weeds explaining everything about FIAs. I will continue to do that in upcoming lessons. In this lesson, I really want to focus on fees and helping you understand why there are fees on certain types of annuities and that some of them have no fees. So next, let's look at SPIAs and DIAs. SPIAs and DIAs have no fees. SPIA stands for Single Premium Immediate Annuity, and DIA stands for Deferred Income Annuity. And these are two types of income annuities, so we lump them into one type. The difference is that a SPIA is going to start income within 12 months, so this is ideal for an immediate retirement paycheck. A DIA is going to have income start later, anywhere from 2 to 10 years out, and it allows time for the payout growth. The key benefits of SPIAs and DIAs are that they give you lifetime guaranteed income, there's no market risk, you have a predictable pension-like payment. An important trade-off to consider is that once the income begins, principal is no longer accessible. You're trading control here for guaranteed cash flow. So there are some drawbacks to SPIAs and DIAs, different from a fixed index annuity with a lifetime income rider. So let's look at the differences. Right at the top, you'll see SPIAs and DIAs have no fees, whereas an FIA with an income rider has that 0.9 to 1.25% rider fee. Remember, that's optional. If you want the income, you're going to have a rider and there's going to be a fee attached. With a SPIA or a DIA, there's no liquidity. You can't access any of the account value. Once you turn that income on, you're just going to get that monthly amount. Versus with a FIA, you have partial access to the account value, so you have some liquidity. With a SPIA and DIA, the growth potential doesn't exist. You're getting a fixed payout only. With an FIA, you've got indexed growth plus guaranteed income. With a SPIA and DIA, you have limited inflation protection. You can add optional riders that are going to allow you to have a COLA, a cost of living adjustment. It's going to decrease your initial income and then it will increase over time. So look at the numbers and compare them when you are talking to somebody about a SPIA or a DIA. With an FIA, you have optional rider increases. There are multipliers on the income, like I discussed before, for long-term care and critical care needs. And also many retirees will practice annuity laddering so that they can turn on more income at different points in their retirement as a strategy to deal with inflation. For a SPIA and DIA, the legacy value usually doesn't exist. Often when you turn on a SPIA or DIA income, you have to opt into having the option for the principal balance to be returned as a death benefit. And if you don't exercise that option when you initiate the contract, once you pass, the money's going to go to the insurance company. Whereas with an FIA, the remaining value passes to heirs. And last, with a SPIA and DIA, there's no Roth or tax flexibility. With an FIA, these can be used to do Roth conversions and tax planning. So there's flexible withdrawals and conversions with some annuity companies. I've talked about this in several other videos where annuities can be a strategic, safe way to protect your principal as you're converting from an IRA to a Roth IRA using an annuity. If you use a Roth-friendly company, you can do partial conversions and plan strategically for tax purposes. And you can't do that with a SPIA or a DIA. So overall, SPIAs and DIAs are best for simplicity, max immediate or deferred income, and FIAs with income riders are going to be best for flexibility, legacy, and adaptive guaranteed lifetime income. Now let's break down MYGAs, or multi-year guaranteed annuities. Remember, we're focusing on fees in this lesson, so MYGAs have no fees. Again, another annuity that has no fees. What you get with a MYGA is a locked-in fixed interest rate for 3 to 10 years with no fees. So you get tax-deferred growth, principal protection, and flexible access. So your interest in a MYGA compounds year after year after year. That's tax deferred. Plus there's principal protection with a guaranteed contractual interest rate that you get year after year, and you know exactly what you're going to get. Plus you get flexible access. So dependent on the MYGA, some offer optional interest withdrawals that are penalty free, and some offer up to 10% annual penalty free withdrawals. This gives you liquidity when you need it. Some people like to put large portions into MYGAs and just draw off the interest and use that as retirement income. Other people use these as growth strategies for a very safe bucket in their portfolio. So the way that you want to think about a MYGA is that it's a fixed annuity, not a fixed index annuity. There's a difference there. Remember, this is just a multi-year guaranteed annuity. It's a fixed annuity. It's not tied to the index. There's no fee, no risk. You get principal protection and tax-deferred growth. And at the time of this recording in 2025, you can purchase a 10-year MYGA with an A-rated company that would give you 5.7% per year of tax-deferred growth. The rates fluctuate, and there are decreased rates for shorter periods. So if you have a 3-year MYGA, you're going to get a lower rate than a 10-year MYGA. But the important thing here is no fees, tax-deferred growth, principal protection, flexible access. So now let's see why variable annuities might not be the way to go. Variable annuities are market-based annuities where you can lose value, and they also carry layered fees. And one of the reasons that variable annuities have these fees is that they function as an investment-based annuity. Your money goes into subaccounts that act like mutual funds. And so your account value goes up and down with the market. This means they come with multiple layers of fees because you're paying for both the insurance structure and the underlying investments. Now, the mortality and expense fee is approximately 1.25% annually, and this covers things like admin expenses, marketing, guarantee that if you pass away, your beneficiary gets at least your original investment minus withdrawals, and it's the base insurance cost charged by the annuity company. They can range from 1 to 1.5% currently, and you'll see this right on your statement. It'll say M&E fee, and you pay this fee whether your investments go up or down. So if you have $500,000 in a variable annuity and the M&E charge is 1.25%, that's $6,250 per year for just this one line item. The second fee, investment subaccounts, typically charge between 0.8 and 1% per year. These are fund management fees, and each investment account has its own expense ratio, just like a mutual fund. And these are charged internally and often not visible unless you read the fine print of the contract. You're paying this in addition to the M&E fee. And this is one of the reasons why financial advisors often prefer variable annuities, because then their assets under management fees can make sense because they are quote unquote managing your variable annuity. I said this earlier, but I want to say it again. It's important that you look at your statements with somebody who's going to explain the fees to you. When I've done this with clients and we look at their variable annuity contracts, they are shocked how much they've been paying in fees. And this can really compound over a long period of time. So you want to pay attention to whether or not you are getting your bang for your buck when you're paying fees on a variable annuity. Again, this is why I don't sell variable annuities. I'm not licensed to, because you have to be securities licensed because you've got those investment subaccounts. Also, because as you know, I use safe money strategies with contractual guarantees for my clients so that they know exactly what they can count on in the retirement era of their life. One more fee to consider here are the optional riders. Many variable annuities offer add-on features. Sometimes there's a GLWB, which is a guaranteed lifetime withdrawal benefit, would provide guaranteed income for life. So it'd be similar to the fixed index annuity with an income rider. Variable annuities can have the same thing. GMIBs, which are guaranteed minimum income benefits, and these promise an income in the future regardless of market performance. What that says there is that you can lose money in your variable annuity, and they're offering you a guaranteed minimum income so that you're somewhat protected in case there are large downturns in the market and you're ready to take income. You're going to get a minimum amount, but you're going to pay an extra fee for that rider. When you're considering these riders, if you're looking into variable annuities, keep in mind that each of those additional riders are going to have their own fee. So this is usually between 1 to 2% of your benefit base. And I've seen these riders add up to 2 to 2.5% for people, and they didn't know that they were paying for these additional riders. Sometimes even for people who don't need income or want income, but they didn't know when they were purchasing the annuity not to opt into that optional rider. So they were paying fees for years on optional riders that they didn't need. Other hidden costs and considerations for variable annuities would be transaction costs inside funds. These can range from 0.1 to 0.3%, and administrative costs where they can tack on a flat fee per year, $30 to $50 for those admin fees. And then really consider the rider compounding problem. Some rider fees are calculated annually on the growing base, not your shrinking cash value. So this means you're paying more and more each year. So I say all of this not to say that variable annuities are necessarily bad. I just want you to know that they are high fee. And variable annuities are typically the reason that people say annuities have high fees. But I've laid very clearly out in this lesson that there are many annuities that have no fees. Variable annuities are not one of them. And this is really why transparency matters so much. When you're working with your financial professional, make sure that you're having them clearly show you the fee structure so that you understand what you're paying for. When I work with my clients, I send you a video describing every detail in the contract of the annuities that we use so that you're clear about what you're paying for. So in a quick comparison recap of annuities, you'll see here that SPIAs and DIAs have no fees, MYGAs no fees, FIAs with no riders have no fees, FIAs with a guaranteed lifetime income rider has a 0.9 to 1.25% fee, and variable annuities can go all the way up to around 4% per year in fees. So when you're considering the different types of annuities and you're wondering about the fees, that is what you want to be considering. And you want to use SPIAs and DIAs, MYGAs, and FIAs for safety and protection because there's no market risk. With a variable annuity, you have high market risk. With SPIAs, DIAs, FIAs with income riders, the guarantee that you get is that you have guaranteed lifetime income. A MYGA is going to give you fixed interest growth, and FIA gives you growth with principal protection, and variable annuities are market dependent, meaning they don't have the same guarantees. So if you're looking for guarantees, go with a SPIA, DIA, FIA, or MYGA. And because we're here talking about retirement income, if you're wanting guaranteed lifetime income, a SPIA, a DIA, an FIA with an income rider are going to be the annuities you want to look at for retirement income needs. And then MYGAs and FIAs can give you safe growth with protection. A variable annuity is going to be for you if you're okay with market risk and no guarantees. So how are you going to evaluate annuities when you're talking to a financial professional? Be sure to ask the right questions. Just straight out ask this question: what guarantees am I getting for this fee? And when you're reading through the contract and the paperwork, the illustrations for annuities, don't be afraid to ask questions. Next, reframe the fee. If you're looking at the rider fee on an FIA for lifetime income, reframe that fee in your mind, because it's not a penalty. The reason you're purchasing an FIA with an income rider is that you want guaranteed lifetime income. So that fee is paying for you to have access to guaranteed lifetime income no matter how long you live. You're looking for that insurance protection of getting a pension-like payment for the rest of your life from the base premium that you put into that fixed indexed annuity with that income rider. So that fee has value to you differently than paying fees that might be eating away at your assets. And again, analyze the contracts in plain English. What I mean by this is compare contracts side by side with the help of your financial professional. And a key takeaway here is full transparency. Don't be afraid to ask questions of your licensed agent who is willing and able to explain the features and the fees. Like I said earlier, when I'm working with clients, if you want me to review your contracts and the current annuities that you have to see what fees you're being charged, we can do that. And when you're looking to purchase a new annuity, I'm going to break it down very clearly for you. So the key takeaways: some annuities have no fees. SPIAs, DIAs, MYGAs, and FIAs without riders charge zero ongoing fees. Riders are optional. They add value when guaranteed income is your goal. Variable annuities cost the most. They carry the highest fees, 3 to 4% on average, plus market risk. And always remember, transparency wins. Clear information helps you make confident, informed decisions. If you want to meet with me to talk about how annuities could fit into your plan, go to retirementIncome.school. Click on the button at the top of the page that says book a Q&A call. We'll have a conversation over the phone, and if we move forward, we will meet over Zoom. We'll review your current situation. We can review policies. I can help you understand annuities so that you can make a financially educated decision. Again, retirementIncome.school, book a Q&A call. I look forward to meeting with you. That's a wrap. If you have not yet subscribed to the Retirement Income School on YouTube or the podcast, be sure to do so now. Turn on the notification bell so you never miss out. Give us a thumbs up, leave reviews. This helps the Retirement Income School reach more people. And continue to stick with me here at the Retirement Income School, where you'll learn to keep your money safe and make it last so you can enjoy retirement. This content is for educational purposes only and is not financial, legal, or tax advice. Always consult a qualified professional before making decisions about your retirement.